Once you sell your crypto, the gains or losses become realized, and there are tax implications. Your Bitcoin investments are the same as any other capital asset, and the IRS takes cryptocurrency taxation seriously. So it's wise that you do so too. In this video, you'll learn everything you need to know about Bitcoin and taxes. Let's begin with a primer. Capital assets. Unlike Bitcoin, we tend to think in terms of dollars and cents when it comes to taxes, but it really makes little difference to the IRS. If you didn't know, virtual currency is considered to be property. The same principles apply to Bitcoin as when buying or selling a home. Here's a quick rundown to understand it all. First, a capital asset is anything you own, such as your home, cryptocurrency, stocks, bonds, etc. Second, the basis is exactly the amount you paid to purchase said property, including any fees. And third, capital gains and losses are the profit or loss incurred for said property and remain unrealized until you actually sell the property. What does this mean? Once you sell your crypto, the gains or losses become realized and there are tax implications. Now let's get into it. Gains and losses. Since the IRS has determined that Bitcoin is considered property, not currency, accrued long-term gains and losses will be taxed at each investor's applicable capital gains rate. Long-term means the property or crypto has been owned for 1 year or longer before being converted to fiat. This is good news as opposed to gains and losses being taxed at ordinary income rates, which is the case with short-term gains and losses. The IRS caps net capital losses at $3,000 per year for married and single filers on personal tax returns. This limit has been effective for nearly 40 years, and it means that large short-term trading losses may have to be carried forward for years. So, if you have suffered trading losses, it's important to understand the write-off is not the same as with foreign currency losses against ordinary income. Fair market value. The IRS requires the reporting of the fair market value of Bitcoin holdings for the date that the currency was received, which brings us to the other issue of the cost base. It is important to be consistent if you determine this fair market value using a daily high or low value from exchanges. In other words, if you use a daily high from one exchange, don't use a daily low from a different exchange to artificially reduce your tax liability. Of course, there is currently no way reporting can be 100% consistent across these lines. Traders have the right to calculate their cost bases using one of several different methodologies. This could include first in and first out, or FIFO, last in and first out, or LIFO, or specific share identification. A major impact on the calculations of both long and short-term capital gains could be the result depending on which is used. For example, if you bought coins more than a year ago and used the buying price as the cost base, you would benefit from a lower long-term capital gains rate. You could also sell the shortest held Bitcoins and realize a lower nominal gain but be taxed at a higher capital gain rate. So what does this mean? Well, as an investor, you may prefer to sell off Bitcoins purchased at a different time as a means of writing off ordinary income. Then you might sell a different lot in order to realize a smaller long-term capital gain. These legal personal accounting methods could result in significant tax savings. E-commerce Bitcoin taxes. The IRS has deemed there is currently no exemption for de minimis property gains or losses as there are when using foreign currencies. The IRS requires that the Bitcoin investor keep track of each incremental capital gain and report them via a Form 1099-B come tax time. A basic example to wrap your head around this could include buying a cup of coffee from a vendor accepting Bitcoin. In doing so, you would constitute a gain or a loss. And if you are a long-time investor having seen Bitcoin value rise, there would be a significant capital gain tax. This brings us to another topic of Bitcoin transactions: donation, tips, gifts. Making donations to charities in Bitcoin can present a significant tax liability. If one were to sell the Bitcoin being donated, either a 15% or 25% tax liability would be realized. The donation is considered tax exempt and can be used to offset the liability. For the investor, it could be more tax favorable for the donor to give the charity Bitcoins directly, which had been held longer than a year. The IRS allows donors to write off the entire fair market value of the donated property held for over a year, up to 30% of adjusted gross income, without stipulating a capital gains tax. The recipient of a gift is usually exempt from taxes for that gift, although that may not always apply when it comes to digital currencies. The issue is that gifts of property, which realize a capital gain or loss upon sale, are taxable. Whenever a gift is converted into cash or used to buy something, it is a taxable event. Lost, stolen, hacked. Lost, stolen, or hacked Bitcoins are governed by Section 165 of the tax code. Individual losses are subject to a $100 floor and are deductible, but only to the extent that the taxpayer has a total loss for that year in excess of 10% of adjusted gross income. Unfortunately, and this is the case for a few, if your private keys were lost, stolen, deleted, destroyed, or damaged, you will not be able to write off the losses. The bottom line: whether you're interested in crypto as an investor or trader, it pays to learn about the tax implications and make wise decisions. Since the vast majority of Bitcoin users have not paid taxes on their transactions, you can bet the IRS is paying close attention. No gains are worth the interest, penalties, and stress of having the IRS on your case. We hope this video clarified your questions about Bitcoin taxes. If you have more, feel free to drop us a line or see some of our other guides on our site. And one more thing, if you like this video, be sure to like, comment, and subscribe.